Picking your own stocks feels clever, spotting the next big company before everyone else, buying low, selling high, retiring early. That's the dream, right? Here's the problem. 92% of professional fund managers, people whose entire career is picking stocks, can't beat one simple investment. Not for a month, for 20 years straight. And that investment? You can set it up in your ISA in about 5 minutes. No spreadsheet, no Bloomberg terminal, no suit required. By the end of this video, you'll know exactly what it is and what it's returned, in actual pounds, and whether stock picking can ever make sense. But first, let me show you why this comparison matters more than most realize. Picture this. It's 2005. You've got £10,000 sitting in a savings account, earning almost nothing. You decide it's time to invest. You've got two choices.
Choice 1. Pick a handful of stocks that look promising. A big retailer, a media company, maybe something in tech. Choice 2. Put the whole lot into a boring fund that just tracks the 500 biggest companies in America. No research, no decisions. Just wait. Most people assume option 1, the exciting one requiring skill, must be better. Why settle for average when you could aim for exceptional? But the data tells a different story. And once you see the numbers, you'll understand why the world's best investors make the same boring choice. So let's break down exactly what's going on, starting with what this investment actually is, because it's simpler than you might think. The S&P 500. You've probably heard the name, but let's be clear on what it actually is, because it's simpler than it sounds. It's an index, a list of the 500 biggest publicly traded companies in America. Apple, Microsoft, Amazon, Nvidia, Alphabet, all in one basket. When you invest in an S&P 500 tracker fund, you're not picking any single company. You're buying a tiny slice of all 500 at once. Think of it like this. Instead of betting on one horse, you're betting on the entire race. And then some. If one company collapses, the others carry the weight. If a new giant emerges, it gets added automatically. The portfolio evolves without you lifting a finger. Now, what has that actually returned? Over the last 100 years, the S&P 500 has averaged around 10% per year. Over the last 40, 11.5%. And over the last decade specifically, 277% total. That's nearly 4 times your money in 10 years. Put those numbers in real terms. £10,000 invested in an S&P 500 tracker fund 20 years ago would be worth around £78,000 today. Through 2 financial crashes, a global pandemic, and a cost of living crisis. Through all of it, £78,000. Here's where it gets really interesting. Let's be fair, individual stocks can produce extraordinary returns. Apple turned £10,000 into over $600,000 in 20 years. Nvidia did even better. And that's exactly what makes stock picking so seductive. You look at those numbers and you think, if I just picked one of those, I'd be set. The question isn't whether great stocks exist. They clearly do. The question is whether you can reliably identify them before they become great. That's very different. For every Apple, there's a Kodak. A company that dominated its industry, looked invincible, and then collapsed into irrelevance. For every Amazon, there's a Blockbuster. For every Nvidia, there are hundreds of technology companies that promised to change the world and quietly went to zero. Nobody talks about those ones. Survivorship bias. The winners are visible. The losers are forgotten. Nobody makes a video celebrating the £10,000 they turned into nothing by picking the wrong stock. Sound familiar? That feeling of regret when you almost bought something? That feeling of confidence when something you picked went up? Both feelings are working against you. Now here's the number that should stop you cold. 92% of professional fund managers failed to beat the S&P 500 over 20 years. These are not amateurs. Finance degrees from top universities, teams of analysts, access to data the public will never see. They still can't beat the index.
The average retail investor, even worse. Studies show the typical person investing on their own earns around 2.6% per year. The S&P 500 earns 10. That gap, compounded over 30 years, is the difference between a comfortable retirement and running out of money. Not because retail investors are stupid, Because of timing. Panic selling when markets fall. Buying back in after they recover. Missing the 10 best days in market history cuts your returns by 55%. 7 of those 10 best days happened within 2 weeks of the 10 worst days. You can't avoid the crash and catch the recovery. Nobody can. I know, I promised to tell you why some people still choose individual stocks, and we'll get there. But first, the most practical part of this video. The good news, this doesn't require a financial advisor, a stockbroker, or a large lump sum.
In the UK, the best way is through a stocks and shares ISA, holding a low-cost tracker fund. The most popular options are the Vanguard S&P 500 ETF or the iShares Core S&P 500 ETF, both widely available, on platforms like Vanguard, Hargreaves Lansdown or Invest Engine. The cost? Less than £20 a year on a £10,000 investment. You invest, the fund tracks. Done. Any growth is sheltered from capital gains tax inside your ISA. HMRC doesn't see a penny of it. That's the legal tax-free wrapper most people never use properly. And individual stocks? If you genuinely enjoy researching companies, understand the risks, treat it as a hobby, there's nothing wrong with allocating a small slice to individual picks. Just don't bet your retirement on it. The index is your foundation. Stock picking, if you must, is the decoration, never the other way around. Right.
Let's land this. First, understand what you're actually buying. The S&P 500 isn't a single stock or a bet. It's 500 of the world's biggest companies, automatically rebalanced, constantly evolving. You own a slice of the entire US economy without making a single decision about which company to back. Second, let the numbers do the talking. £10,000, 20 years, £78,000. No stress, no stock picking, no watching the news in a panic. Time in the market beats timing the market every single time. That's not a slogan. It's backed by over 100 years of data. Third, open a stocks and shares ISA if you haven't already. You have a £20,000 allowance each tax year that shelters your returns from tax completely. Every year you leave it unused, you're handing HMRC something they didn't need to take.
It's one of the best free tools in the UK tax system. Fourth, if you do want to pick individual stocks, be honest with yourself. It's a higher risk bet on one company's future. Keep it small, not your whole pot. Remember that 92% figure I opened with? Now you know exactly why the boring choice is often the smartest one in the room. If this video has changed how you think about investing, even slightly, then it's done its job. Knowing this puts you ahead of most people who spend years chasing the next big stock without ever asking whether the hunt is worth it. Now you know, and you can act on it. Hit subscribe if you want more of this. We put out a new video every week breaking down your money in plain English. No jargon, no suits. Until then, no more monkeying around with your money. This is Monkey Finance. See you in the next one.